Good morning and welcome to the Monday Call, brought to you by NZ Funds. I'm Stefan Clark, Chief Client Officer. Cash, until recently an overlooked asset class, is now in the spotlight. Higher interest rates have made cash attractive again. At the same time, the government has announced that the trust rate will jump from 33% to 39% next year. This means that the product type investors choose to invest through is a more crucial consideration. With a top tax rate of 28%, PIEs, or portfolio investment entities, will soon offer up an 11% difference for investors. Such a difference can have a big impact on the long-term compounding returns investors receive, not just for cash, but also for shares and bonds. Today we're joined by Mike Gray, Principal and Senior Counsel at NZ Funds, and Mark Brooks, Head of Income at NZ Funds, to discuss the benefits of investing through PIEs, our views on interest rates and inflation following the Reserve Bank's OCR statement, and how investors are using the NZ Funds cash portfolio to deploy their capital. Welcome, guys. It's great to have you here. So we'll be covering really three sort of separate but connected topics that I think are probably top of mind for many investors. Interest rates, changes to the trustee tax rate, and how different asset classes are taxed. Mark, let's start with you. Why is cash now in the spotlight, and what's made it attractive again?
Well, I suppose, as we've talked a number of times, we've been through this massive cycle where, as we went into COVID, interest rates globally just got slashed to basically zero. So, for a long time, people have kind of forgotten that actually cash in the bank has a potential, or cash assets have a potential to actually earn them a return. They got used to getting zero on that. Central banks around the world, not just in New Zealand, but around the Western world, have rapidly raised interest rates over the last 2 years. And we now end up with cash in the region of 5.5%. And if you think about sort of your long-term returns, if you're looking at looking at growing your wealth and compounding your wealth at sort of 7-8% is sort of out of as you move up the risk spectrum. Cash gets you a long way closer to that now, so it's makes it attractive. Not a long-term solution to grow your wealth, but definitely one to make sure. I suppose people need to give it due thought now and actually think about how they structure it and make it work for them. Really.
Righto. And what's driving the increase in tax rates? in interest rates.
Interest rates. Well, I suppose, again, stepping back, we had, and I think, we've in New Zealand, it was kind of very, in an odd way, very obvious that, as we went through that initial COVID phase, definitely the world stopped. You saw interest rates be slashed. You saw a massive amount of government spending. But as we moved out of that, especially in 2020, and the rest of the world was still in COVID lockdowns, everything bounced back very quickly. And we've seen that sort of time and time again now, that across the world, as economies have opened up, they've got back to normal life very quickly. At the same time, you've had this sort of, governments and central banks were effectively hard on the accelerator. They'd cut rates to encourage people to do things. Governments were busy spending. And that ultimately means that from an economic point of view, the economy is kind of running hotter than it should. And again, to use that sort of car analogy, it's approaching corners at a pace faster than it should. And essentially what the Reserve Bank is doing is putting their foot on the brake. And at 5.5%, foot's on the brake pretty hard, actually. So that's why interest rates are there.
And so the Reserve Bank has raised the rates, the OCR, and at a rapid rate, but they're also making forecasts around where the economy and where the direction of inflation and interest rates are heading. Could you take us through what their thinking currently is?
Yeah, we had their, what would it be, sort of 3 weeks ago now, 2.5 weeks ago now, their latest statement. And I think in many respects it was kind of pleasing after, they've been through this very aggressive period of raising rates where they wanted to actively move interest rates higher to slow the economy. Yes, they raised rates again to sort of from 5.25 to 5.5, but they kind of acknowledged that actually what they've been doing is working. The economy is slowing, and in terms of the hard information recently, the GDP number was lower. We actually get another one very shortly. It'll be interesting to see, but that debate whether that will be a positive or negative number, but it's still going to be low at the end of the day. So the economy is slowing. CPI inflation is coming down. It is still way too high by most measures, but it is coming down. So certainly they are seeing signs that their actions on the brakes are working. We had retail sales just after the Reserve Bank came out, actually, and outside of restaurants and clothing, every sector was negative in that on a post-inflation basis. So that's really what they're trying to do. They're saying, well, we want to slow the economy. They've acknowledged that it is working, but I think the challenge, we now move into a different phase. We've been in a period where rates are rising. It's unlikely, probably, and essentially the bank said that we're essentially at the peak. Yes, we don't expect rates to rise. It really becomes a question of how long are they here, and at what speed do they come down? And that's kind of the magic question at the moment. And there's a number of factors sort of working in both directions on that.
And what are the views that you hold currently about which direction it's going, and this, the importance of the different factors?
Yeah, I think we've had a long-held view that inflation generally would be higher in this cycle. Even the lows of inflation will be higher in the cycle than what we saw last time. So that sort of says at a very broad level that we think inflation can come back to 3 or 4% quite easily. But getting it below that is going to be a real challenge. And I think we're in that path now where inflation is coming down towards that sort of 4% level. But after that is going to be interesting. And I think there's a couple of things that point to that and a couple of things to watch from that. Firstly, probably the two key issues at the moment. Yes, the economy's slowing, but we do have some positive impulses. Two big ones would be migration and government spending.
Right.
In terms of migration, that is, and I think the Reserve Bank sort of correctly looked at it and said that, yes, we've got strong migration, sort of potentially heading for up to sort of 100,000 people per year. Those are big numbers. Those are sort of getting up to sort of 2% of population growth. And if you think that economic growth is is a combination of population growth and productivity, 2% population growth is a big deal. But the Reserve Bank sort of said, well, we know migration's very high. We do think there's some pent-up demand there and it will drop off again. At the same time, we know the labour market is very, very tight and wages have been front and centre in terms of their concerns. So from that point of view, actually migration potentially is a positive because it fills those available jobs and actually probably diminishes or turns the volume down in sort of wage expectations going forward because there won't be that sort of same gap between demand and supply. And at the margin, things like SEEK job ads, etc., are suggesting that is the case. In turning to government spending, I was a little surprised the Reserve Bank was so relaxed about the government budget. At the end of the day, to really get inflation under control, you need both sides of both monetary policy and fiscal policy working in the same direction. At the moment, we've got monetary policy, the Reserve Bank, with their foot hard on the brake. Actually, in many respects, the government has got their foot on the accelerator. They are spending quite a lot. They're spending more than they're bringing in. So that is expansionary. And, that's one of the challenges, I think, going forward. So, that's a slightly long monologue. But in terms of the importance going forward, I think the key factor that the bank will look at, and I think the markets will look at, is what is happening to wage inflation. If there is any sign that wage inflation is remaining robust, I think that becomes a real challenge for interest rates coming down.
And so back at 1% and 2% is not going to happen anytime soon.
Correct. Always a crystal ball, but you're probably looking at the OCR's 5.5 now. You're probably looking at an OCR maybe 3.5. At would be more of what I consider a neutral rate. Foot off the brake, maybe not hard on the accelerator, but foot off the brake. But it could take some time to get there.
Okay. All right, thanks for that, Mark. So recently the government's announced an increase in the trustee tax rate from 33% to 39% with effect from 1 April 2024. Mike, please take us through the decision and what that broadly means.
Thanks, Stefan. So in the budget, the government did announce that they were going to increase the trust tax rate, possibly a little surprising given that they had the opportunity to do that when they put the top individual rate up a couple of years ago. But nevertheless, they've decided to go down this road. And I think the catalyst for it is very much the report from the IRD on high net worth individuals and the perception that trusts are primarily a vehicle used by those people to shelter their income. So effectively pay a tax rate of 33 cents. I say perception because depending on which commentators you look at, there is definitely the case to be made that the high net worth individuals do use trusts. But there's also a very strong case that most trusts hold one asset, and that asset is the family home. That they're used by what the politicians love to talk about, the ordinary New Zealander. They're used for asset protection purposes for people who have small businesses. So the jury's really out on what the practical effect of the change is going to be, assuming it comes in on the 1st of April next year. Will it increase the tax take? Yes, for those trusts that have significant investments, significant income. But suggestions are that's the minority of trusts.
Interesting. Okay, and at the same time we have the PIE regime, which most collective investment vehicles in New Zealand are set up through. Can you take us through how the PIE regime works for different investor types and what that means for trusts and following the changes that are afoot?
Yeah, look, it's an interesting one, and one of the things that the possibly unintended consequence of increasing the trust tax rate is that it widens the gap between what the top PIE tax rate is and what the top trust tax rate is. Currently, an investor in a PIE is capped out at 28%. That was a 5% spread on a trust now at 33. That goes to 11. Is that an intended consequence? Probably not. Is it a consequence that's been thought about? Probably not. The trust tax rate rise is it's a headline grab. With PIEs, and this exists now for a high net worth individual, for anybody on a 39% tax rate, there is a effective gap between what you pay if you invest through a PIE at 28 cents and what you pay if you invest directly for example, to stay in the cash space, a term deposit. You will pay tax on the interest at 39% if you're a top taxpayer. For a trust, so for individuals, that means that PIEs have an advantage if you're on a 30, 33 or 39% marginal tax rate, and that is the case today. That advantage is being expanded for trusts in that the 39% now will apply to them from the 1st of April. So that tax advantage is there as well for the funds that the trust wants to keep for itself, if you like, not pass out to its beneficiaries. But trusts still have a benefit in the PIE tax regime for income that's being passed out to beneficiaries. Trusts can elect multiple tax rates. Most obviously, it can elect 0. And if it does that, then when it passes that income out to its beneficiaries, that income's taxed at the beneficiary's marginal tax rate. That can be 14.5%, for example. And if you've got beneficiaries with multiple tax rates, you can effectively pass income out to them and have it taxed at their rates rather than at a flat rate within the trust. So that advantage is there. It's there today. That advantage will stay there, all things being equal, post the changes in tax rates.
Right. And so that wedge, 11% of tax might not sound a lot in the first instance. Perhaps it does. But over a longer period, say you're investing for for 10 years. I think we did some modelling, and if you're on you're investing via a term deposit at 5.5% or a term PI at 5.5% and the same return profile, and you are a trust or 39% taxpayer, you end up with 8% more, gains after 10 years. So it might not sound again like much, but if you step back, if you've got $100,000 and you're investing after 10 years, that difference in tax is $8,000 in returns, which is actually very meaningful, all other things equal. And so the structure you invest through or the product type you invest through really matters.
Yeah, I think it kind of gets back to the heart of investing. People sort of think, how do we drive returns on a year-to-year basis? But actually, the real secret to investing is about getting those returns compounded over time. And if you can do even little things like this at the sort of riskless end of the spectrum, that's a great start for your investment solution.
Should, of course, caution that tax is only one factor that should play into decision making, and there's a whole range of other factors, but it is an important factor which investors should take into account. Okay, well, thanks for that, mate. There are, of course, other types of assets. So we've got, there's cash and term deposits, bonds and shares, and they tend to produce different returns over time. So let's just assume that cash produces 5.5% for our purposes, and bonds 6.5%, and shares sort of roughly 10%. In any given period, it's sort of up or down, and it depends on region and so forth. But over the long term, that feels about right. Take us through how the different asset classes. So let's start with, say, shares, get taxed, and then we can move to the others along the way.
Yeah, no, that's great, Stefan. There are different regimes, as I suppose we all are aware, that tax how we invest. Starting with shares, basic split is between New Zealand Australian shares and global shares. New Zealand Australian shares, we don't pay tax, or most people don't pay tax on capital gains on those shares. Dividends, they are generally from New Zealand fully imputed. And the effect of that is on that 10% return that you mentioned, Stefan, after tax, investing through a PI, if you're taking a 28% tax rate, you're looking at an after-tax return of around 9.75%. Pretty good if you think about that from a tax perspective.
So, sorry, to be fairly simple, given the PI is still paying 28%, how do you end up with such a small difference?
Because you're picking up those imputation credits on the way through. So the company's paid that tax, passed it out to the PI or the investor.
30%, right?
Paid that at 28%.
Yep.
Global shares. We use the fair dividend rate for most global shares. That's a fancy way of saying that we assume that the return on those shares is going to be 5%. And that return is your taxable income, irrespective of what you actually make from an economic perspective. So, putting it simply, earn 9, your taxable income is still 5. On the 10% return that Stefan's talked about, that gives you, through a PI, an after-tax return of 8.6%. Again, they're quite good numbers. Tax rate is helping you to get a good return there. Bonds and term deposits or cash, they're taxed very simply. You're taxed on what you earn, but unlike if one of us invests directly, we're capped out at 28%. So again, using Stefan's numbers and a 28% PI tax rate, you're looking at a 3.96% return for a cash or term deposit, or a 4.68% return if you're looking at bonds. So, Stefan, you made the point that tax isn't the driving consideration, but it is an important consideration because it does have a real impact on those after-tax returns, and how you choose to invest through a PI or not can really help there.
Yeah, okay. And the difference between PIs versus investing individually, are there any things there that investors should know if you invest via a structure or via directly into the assets themselves?
I think I guess any structuring investment, it's got to depend on your individual circumstances, on what's right for you. PIEs are a very, very simple way of everybody accessing what is deliberately a concessional tax regime. It's not an accident that there's that gap there. It was there. It's there now for trust at 33. I think the important thing from a tax perspective with anything like this is you go out and you get advice on your investments. You get advice on your financial plans. You get advice on your tax. If you are going to structure, get advice. Make sure that what you're doing is right, and that way you'll get the best outcome from both an investment perspective and tax perspective.
Going back to Mark's point just before about the benefits of compounding over the long run, and then this being a material factor, but of course not the only factor. Again, we did some modelling using those numbers at 5.5%, 6.5%, or 5.5% for cash, 6.5% for bonds, and 10% for New Zealand and global shares. And it was really remarkable over a 10-year period what the outcome was if you invest via a PIE versus directly as a 39% taxpayer, but the same would apply for other taxpayers above the PIE tax rate to a lesser extent, of course. But if over a 10-year period you invest in TDs at 5.5%, you would end up at the end of 10 years after tax at about a 40% gain. So $100,000 after 10 years would, after tax, end up at about $140,000. Whereas if you invest in shares, New Zealand shares being the most tax effective, with assuming that 10% return, you end up with $230,000 or more. So you end up with more than double your initial investment, and the after tax outcome is just hugely different. So tax matters and assets matter.
Yeah, I think I'll just sort of come back to a point I try to make to people is that ultimately the entire role of the investment industry is basically whilst we are sort of talking about the cash returns now are good, they're higher than they've been for many years, but ultimately the aim of our industry is to encourage people to take on a little bit of risk. Because the more you move up that risk spectrum and take some risk in terms of your investments, that's how you drive return through that compounded return. In the extreme, I think what was it, 200? What you're turning $100 into 200 over 10 years. That means over 20 years, that $100 becomes $400. So you really do get that benefit of compounding, working through, taking a little bit of extra risk. And again, not to harp on the point, but if you look at how people in New Zealand have generated wealth over time, it's about taking risk, be it buying that house or something like that, starting that business. That's how people drive return. And this is ultimately what our industry is trying to do.
Okay. Well, it wouldn't be fair to complete this sort of analysis of assets and tax if we didn't touch on property briefly. So there's two big themes that are sort of playing out in the property space around the bright line test and deductibility. Can you talk us through that at a high level, Mike?
Yeah, look, I will start at a very high level because it's quite a complex area. The bright line test was designed to try and capture the gains that were being made out of the property market. Post-COVID mainly, when the property market just really took off. The rules basically, you've got to own the property for 10 years in order to achieve a capital gain on the sale of that property. There are a myriad of exemptions in there. So, the most important one, I think, for those on the call is that it doesn't capture your family home. So you can actually move house within 10 years and not have a tax bill. And that's, I think, a very important thing to keep in mind. But there are rules in there that just, even the family home, if you rent out a room, that can have implications. And at the same token, interest deductibility, something that every landlord, everybody who's got a rental property, they take a deduction for all the expenses in that property, and that includes the interest. They've changed the rules over the next 4 years. That ability to deduct interest is going to be removed, 25% a year at a high level. The exceptions are new builds, and there's a whole lot of rules around that. Again, the idea is to try and tame that property market. Whether those rules work or not, we may never know. And it's an interesting, just going slightly off topic, but this is one of the first elections we're going to have this year where tax is actually going to be an issue. We saw the Greens yesterday announce their tax policy, which included, amongst other things, a wealth tax. Wealth tax invariably drives home to property. It's most people's largest asset. We've got the opposition signalling very clearly they're going to repeal a lot of the changes that have been made. So, it does matter. And I think it's for somebody who has a passing interest in tax, it's going to be an interesting election.
Absolutely. Okay. But we talked about different asset classes having different return profiles and how they get taxed in different ways. That over time the investment industry is looking to support people and enable them to move up the risk spectrum, depending on their time horizon and a range of other things. But cash will always have its place. And right now, what do you see as the benefits of investing in cash generally, and then the risks of investing in cash generally, Mark?
Well, I suppose the key benefit at this point is the returns from cash are much higher than they've been for a very long period of time. And as a starting point of your investment decision, those are really nice returns. If you're getting returns over 5%, that's a good starting point. And certainly it provides, if people have, are going through change, sold a house, etc., it's a really good ability for them to continue to generate good returns. The real challenge is that you stay too long in cash and don't look at some of those other asset types that do actually move up the risk spectrum. Come with some volatility. Cash is, the nice thing about cash is it doesn't change in value, at least at a nominal level. The other issue we have clearly is inflation has been high, and cash at 5.5% or 5% will keep up mostly with inflation, and as inflation moves lower, it that generally it will keep up. But the risk is that over time, it does not keep up with inflation. So it's another reason to move out the risk spectrum and into other assets to continue to help that compound return ultimately.
Right.
Again, that would definitely counsel that comes with the advice of a financial planner to make sure that that move up the risk spectrum is appropriate for your age and your stage and etc.
Okay, and NZ Funds offers what we call the cash portfolio, which you oversee as one of the portfolios you're responsible for. Take me through the different elements to that. So how is it set up? And then in addition to, the tax effectiveness, because it is a pie, what other elements to it do you think or are you seeing with investors when they invest in it?
Yeah, well, the cash portfolio is designed for clients to hold their cash in an effective and diversified manner. It's not designed really as a a check account, not that necessarily a check account still exists per se, but shows my age maybe. But it's there to hold their cash. It is accessible. Essentially can withdraw in 4 days, etc. So from that point of view, all of the assets underneath are held in essentially 3 month bank bills. So that's effectively, for want of a better word, a saleable version of a term deposit that we can buy from the major banks, and it is the major banks in New Zealand only. And those 3 month bank bills we can sell at any point in time, and it means that clients get a wide range of exposure or get an exposure across all the major banks, but they get a nice high return. I think it's probably, one going off tangent a bit, but one interesting change that we've seen over the last year or so is that if we go way back to the GFC, the major banks got a large amount of their funding from either wholesale investors like us or from wholesale investors offshore. And typically, those investors like that tend to move around more than retail investors do with term deposits. And the Reserve Bank said after the GFC, well, we want you to have 75% of your funding coming from term deposits from retail New Zealanders. So basically the banks paid up to do that. Yeah, you could get a much better return going to the bank to buy a term deposit with $20,000 than we could going to the bank with, say, $5 million. Yeah, we were actively penalised for that, so we got a lower return. That balance has changed. Essentially, the core funding, as they call it, the retail term deposit funding, is more than the banks need. And with interest rates and the OCR being higher, actually they're paying more for wholesale money than they are for retail money. And really, that's a theme which we'd expect to continue. So at the moment, on a pre-fees basis, we're getting sort of north of 5.5% on essentially our money that is 3-month money. Whereas if you're going to do a term deposit, you're going to have to go out well beyond 6 months to get that sort of level. And that will come with obviously the PI tax, or it's not a PI, so it comes with a tax consideration. But also you're locking up that money, and 6 months may not be too long, but it is still locked in. Whereas one of the key benefits of the cash portfolio is it is available if you want to redeem to put into a house or something like that, or if you want to move it up the risk spectrum into other asset classes.
So, I mean, just to sort of summarise my take on that, you get diversity across a range of banks, which as an individual investor is quite challenging to do. And then you get access to it similar to a call account or a cheque account, maybe fractionally slower, but still nothing like a term deposit, where you're locking it up for north of 6 months, a year or more perhaps, depending on the interest rate curve. And at the same time, you're getting an interest rate that is similar to a term deposit of that length. So you get a lot of the benefits. And
probably the other one, sorry, just to butt in there, that I didn't sort of touch on means you don't have to sort of worry about the management of it as well, is that you don't have to ring up the call centre every 4 months or 5 months and try and agree on your rate. That's what we do. Yeah,
that's fantastic. And so I guess in and after fees, I mean, we charge a little fee for that, but what are the fees on the fund, and how, what does that mean for investors?
40 basis points. So at the moment, the after fee number is 5.2% for the fund.
Still very sharp. Okay, fantastic. And so why? I mean, clients are using it for a range of purposes. They tend to, I think you mentioned before, as you're sort of moving up the risk spectrum. Some people use the cash fund for purposes of, they say they're investing in the markets, they put it in there and then tranche at stages into the market. So that's a fantastic use. If they're sitting on the sideline, they're not sure about where the economy is going, but ultimately they know they want to invest in riskier assets. It's a good place to be. Another situation we've been seeing is people who have an asset purchase that they're looking to make, and they're looking to buy a family home, having sold a property, and they're parking their funds there, so to speak, until they're ready to make a decision around that. Are any other? Have you seeing other situations where people would be using the cash fund?
I think that probably the other one, and this may be more a discussion for Mike, but I think clearly groups like trusts will look to have a portion of their assets permanently in safe, stable assets, just to make sure that they have that emergency funding for potentially for trust beneficiary needs at different points. So it's a really good way to almost sort of set and forget for that portion. Yeah. Again, you don't have that sort of management issue ultimately, and you get a tax benefit.
And I think with the trust, that set and forget is really important. And it's also, I think,
there's also given the new trustee laws.
Correct. It's an easy way for the trustee to be able to tick that box that they are investing in a manner that is in the best interest of the beneficiaries. And set and forget is probably right there. You're doing that rolling for them. They don't have to worry. They've got the tax under control. It's sorted, and they can tick that box very easily.
That's fantastic. Okay, the last thing just to highlight is NZ Fund's a little different in the way it applies its ESG policy across all of its products. How does that apply to the cash fund? So I'm aware that some market participants have ESG considerations in pockets of their suite of products, whereas we apply it across the board.
Yep. Yeah, I suppose one of the real challenges with ESG is, which aspects do you focus on? And a lot of the views they're on a spectrum, I suppose, ultimately, in terms of, some people see some things as being, critically important and will downplay others. So, the challenge for us is how do we manage that process, and do we look to make a individual assessment, or do we have a wider process that applies across the entire business? And we don't want to be in a situation where we just have one ESG fund, but the rest of our funds are not ESG compliant. So in terms of the way we approach it, essentially we use an external manager, ISS Ethics, and their entire business is about going through a defined process and saying, well, is this business, are they able to get a tick in terms of being compliant with all the aspects of E, S, and G, the environmental, the social, and the governance? So, we apply that across all assets, doesn't apply whether it's cash or shares. And in the case of the banks, each of those sort of, get that tick. So, I suppose it goes off tangent a bit, but, that does mean that, say, in my management of the bond funds, you see a number of companies issuing green bonds. Basically, we don't necessarily bring that into our process because we're looking at the entire business, not just our part of their business. And in the extreme, you did have one green bond issued last year where the business, it was being raised to be applied to either to their sustainable investments or notionally applied to their sustainable investments. So that money doesn't actually sort of
necessarily go there. Yeah. It just goes into a pot, perhaps.
Correct. Yeah.
Okay. So wrapping up, I guess the key things that I've taken away from today were, tax and the structure and the product you use. Obviously, it matters, and it's mattering more now that the trustee rate is going up. The asset type you invest in, that gets taxed in different ways. So be mindful of how you're investing and the way you're achieving the returns you're looking to achieve. And then the third one is if you're looking for a cash portfolio that is a pie, NZ Funds has one on offer, which many investors are using, and it's serving the purposes we described quite in this, and gives you a bunch of advantages that investing directly into a term deposit may not make available to you. Very good.
Might ask one question, Mike,
sure.
just to make sure that people understand it. If you are on a tax rate lower than 28% and coming in through a pie, what's the impact there?
High tax rates are graduated, just like all of our other tax rates are. You're not stuck on 28. You can have 10.5. You can have 17.5. There's a really helpful tool on the IRD website that'll tell you what your pie tax rate should be based on your income. But it's definitely still advantageous for those people on those lower tax rates as well.
Perfect.
Fantastic. Thank you, guys. Great to get you on the call, and thank you, everyone, for listening.
Cool. Thanks everyone.
Phil. Thank you.
This has been the Monday Call, brought to you by NZ Funds. New Zealand Funds Management Limited is the issuer of the NZ Funds KiwiSaver scheme, the NZ Funds Managed Superannuation Service, the NZ Funds Advised Portfolio Service, the NZ Funds Wealth Builder, and NZ Funds Income Generator. A product disclosure statement for each is available at nzfunds.co.nz. Past performance is not necessarily an indicator of future returns.